How does time decay, theta, affect a put debit spread? Have you ever wondered how time impacts your options trading strategies? Today, we will discuss the effects of time decay, also known as theta, on a put debit spread. A put debit spread is an options strategy where a trader buys a put option at a higher strike price and sells a put option at a lower strike price, both set to expire on the same date. This strategy is typically used when a trader expects the underlying stock to decline moderately. Understanding how time decay affects this spread is essential for managing profitability. Theta measures how quickly an option's extrinsic value, or time value, decreases as time passes. As options have a limited lifespan, their time value erodes daily, and this decay accelerates as expiration approaches. Theta is usually expressed as a negative number, indicating a loss in option premium over time for those holding long options. In a put debit spread, the trader holds both a long put option and a short put option. The long put option has negative theta, meaning its value decreases as time passes. This works against the trader because the premium of the long put decays daily. On the other hand, the short put option has positive theta from the trader's perspective. This means the option they sold loses value over time, benefiting the trader. The overall impact of theta on a put debit spread depends on the relative theta of both the long and short put options. The long put's theta causes the spread to lose value daily due to time decay. However, the short put's theta offsets some of this loss. This allows the trader to potentially buy back the short option at a lower price or let it expire worthless. Typically, the long put option is at a higher strike price and may be more into money, or at the money compared to the short put. This often results in a larger absolute theta value for the long put. Consequently, the overall position usually experiences a net negative theta, leading to a decline in the spread's value over time if the underlying stock price does not move favorably. In practical terms, if the underlying stock price remains steady or moves against the position, the put debit spread will lose value as time passes. This loss primarily occurs due to the long put's time decay. To profit from this strategy, the stock price must decline enough and quickly enough to increase the intrinsic value of the spread, overcoming the effects of time decay. As the options approach expiration, the time decay accelerates, increasing the urgency for a favorable price move. Traders should keep in mind that buying put debit spreads involves a race against time decay. Holding the position too long without the expected price move can erode potential profits. To sum it up, time decay negatively impacts a put debit spread because the long put option's premium erodes daily. While the short put's time decay partially offsets this, the net effect is usually a loss in value over time if the underlying stock does not decline sufficiently. Successful trading with put debit spreads requires anticipating a timely downward move in the stock to counteract the effects of theta.